Indexed Universal Life Insurance, often called IUL, is one of the most talked about and misunderstood financial products on the market. If you've ever heard an insurance agent describe it, you might have been told it's the perfect mix of life insurance and investing. They might say that it offers growth potential without market risk, that it has tax advantages, and gives you lifelong coverage. While it all sounds appealing, the truth is more complicated. To really understand IUL, you need to know what it is, how it works, where it can shine, and where it can fall short. This video will explain indexed universal life insurance in plain English, break down its moving parts, and outline the pros, cons, and real-world uses, so you can decide if it's right for your financial strategy. So, what is indexed universal life insurance? Indexed universal life insurance is a type of permanent life insurance. That means it's designed to last your entire life as long as you pay the premiums. Like all life insurance, its primary function is to provide a death benefit to your beneficiaries when you pass away. But unlike term life insurance, which is pure coverage, an IUL also has a cash value component. Here's where it gets interesting. The cash value in an IUL doesn't just grow at a fixed rate like traditional whole life insurance. Instead, it's linked to a financial index, often the S&P 500, but it could also be other indices like the NASDAQ 100 or a blend of several. When the index goes up, your cash value has the potential to grow. When the index goes down, you don't lose money directly to the market, because your account isn't actually invested in the index itself. Instead, the insurer credits interest to your policy based on the index's performance, within certain limits. Those limits come in two main forms: the cap and the floor. The cap is the maximum interest you can earn in a given year. For example, if the S&P 500 goes up 15% and your IUL has a 10% cap, you get credited 10%, not the full 15%. The floor is the minimum interest you can earn in a year, even if the index performs poorly. Most IULs have a floor of 0%, meaning if the index drops 20%, your credited interest for that year is simply 0%. You don't lose existing cash value due to market losses, but you also don't gain anything that year. This cap and floor structure is the key selling point for many agents. They position it as upside potential with downside protection. And while that's true in a sense, it's important to remember that the cap limits your growth and that insurance costs still apply, even in years with zero credited interest. This leads us to how premiums work in an IUL. With term life insurance, you pay a fixed premium for a set period. With whole life, you also have fixed premiums that never change. But IUL works differently though. It's considered flexible premium insurance, which means you can pay more or less into the policy within certain limits. Part of each premium payment goes toward the cost of insurance, essentially the fee for your death benefit coverage. Another part goes to administrative fees. Whatever is left goes into your cash value account, where it earns interest based on the index. You can also pay more than the required minimum premium to build your cash value faster, which can give you more flexibility later on. But if your payments are too low, your cash value might not grow enough to cover the cost of insurance in future years, and the policy could lapse. Which leads us to one of the most important and often overlooked aspects of IUL. The cost of insurance, sometimes called COI, is not fixed. It increases as you get older. In the early years of the policy, COI is relatively low, so more of your premium can go toward building cash value. But as time goes on, COI rises, sometimes sharply in later years. If your cash value isn't growing fast enough to cover those rising costs, you may have to increase your premiums just to keep the policy in force. This is one reason some IUL policies fail, not because the product is broken, but because the funding strategy didn't account for the long-term rise in insurance costs. Now let's talk about loans and withdrawals. One major selling point of IUL is the ability to access your cash value without triggering taxes through policy loans. Here's how it works. Instead of withdrawing cash, you borrow against your policy. The insurance company charges interest on the loan, but your remaining cash value can continue to earn interest based on the index. In theory, you could borrow money in retirement from your IUL, never pay it back, and have the loan balance deducted from the death benefit when you pass away. However, loans have to be managed carefully. If they grow too large or if the policy's cash value drops too low, the policy can lapse. If that happens, the loan becomes taxable and you could face a significant tax bill. This leaves us to the many pros of indexed universal life insurance. When designed and funded properly, IUL does offer several potential advantages. 1. Lifelong coverage. As long as premiums are paid and the policy is funded correctly, coverage lasts for your entire life. 2. Tax advantages. Growth inside the policy is tax deferred, and policy loans can provide tax-free access to cash value. 3. Downside protection. The floor means your cash value won't lose value due to negative index performance. Upside potential, the cap allows for potentially higher returns than fixed universal life or whole life insurance, especially in strong market years. 5. Flexibility. Premium payments can be adjusted up or down within limits, and the death benefit can sometimes be increased or decreased. While there are many pros, we can't ignore the cons, as IUL also comes with significant downsides and risks. 1. Complexity. The moving parts such as caps, floors, COI charges, or loan provisions can be confusing and hard to track. 2. Cost of insurance. Rising COI charges can eat into cash value over time, especially if the policy is underfunded. 3. Limited growth. The cap means you never get the full market return in a strong year. 4. Loan risks. Mismanaged loans can cause the policy to lapse and trigger taxes. 5. Agent incentives. Some agents oversell IUL as a magic investment because of high commissions, without explaining the downsides. So IUL isn't for everyone, but it can make sense in certain situations. For example, high-income earners who have already maxed out traditional tax-advantaged retirement accounts and want another place for potential tax-free growth. Some individuals needing permanent life insurance and who want the possibility of higher returns than whole life offers. Estate planning situations where both the death benefit and tax-advantaged growth are important. Or people comfortable funding the policy aggressively in the early years to minimize the risk of it lapsing later. But an IUL may not be ideal if you only need life insurance for a specific period, like 20 or 30 years, in which case term life is cheaper and simpler. You're looking for the highest possible investment returns, in which case low-cost index funds may be better. You can't commit to making consistent, sufficient premium payments over time, or you simply prefer simple financial products without a lot of moving parts. If you're considering an IUL, here are key steps to take before committing. A. Request an illustration. This shows projected performance based on different interest rate assumptions. B. Look at guaranteed values. Don't just focus on the optimistic projections. The guaranteed column shows the worst-case scenario. C. Understand the caps and floors. Know exactly how high your returns can go in a strong year and what happens in a bad year. D. Check the cost of insurance. Ask how COI changes over time and how it's deducted from cash value. E. Plan your funding strategy. Determine how much you need to pay each year to keep the policy healthy for life. Indexed universal life insurance is certainly not a scam, but it's also not a miracle investment that can replace all other financial strategies. It's a tool, one with both benefits and limitations. In the right hands with the right funding, it can be a valuable part of a financial plan. In the wrong hands or with unrealistic expectations, it can lead to disappointment and financial strain. The key is understanding exactly what you're getting and making sure it fits your needs and goals. Indexed universal life insurance combines elements of protection, growth potential, and tax advantages. But it also requires careful planning and long-term commitment. If you're thinking about adding an IUL to your financial strategy, take the time to compare options, understand the numbers, and work with a professional who will explain both the pros and cons in full detail. We hope this video helped you understand what an indexed universal life insurance is and how it can benefit your life. If you like this type of content, make sure you give a like, share, and subscribe for more. Until then, have a good one. See ya.